How do I choose between being an investor or trader? It comes down to one thing. How much time do you intend spending doing the research? How many hours do you want to devote to looking at technical analysis, the charts and the graphs? That's on the one side of the coin. How many hours do you want to spend perusing through financial statements, in other words, a fundamental analysis? Because that will dictate the difference between investing and a trader. So if you're only prepared to spend a small amount of time and you want to do it once, then you are much better off being a long-term investor. So I know there's a bit of a paradox. People always say that a long-term investor, you need a lot more time. No, as a trader, you need much more time. Okay. So if you're prepared to get your hands dirty and devote lots more energy and hours doing research, then you're ready to play or trade the market. In other words, the way to look at trading, you can treat it first of all as a part-time job or even as a full-time job. So it's not just something as a hobby. Trading is a serious business. Okay. So let's get into each one individually in more detail. What is investing? What is the goal of investing? Obviously, you might say, oh, it's common sense to say, yes, my goal is to build wealth. But no, that is we spoke just now about making money, but now it's making more concrete and say, I want to build wealth. How do I do that? I do it over an extended period of time, from a few years to decades. Okay. The strategy you use is a buy and hold strategy. And we'll talk about different strategies just now in more detail. But the idea is that my goal is to build a portfolio of financial assets. And obviously tonight we're talking about the share market, so we're talking about shares. And obviously if you look at asset allocation, there's bonds, there's property, there's businesses and things like that. But in tonight's talk, we're talking about a portfolio of shares with the idea that according to our risk tolerance and our investment objectives or our financial goals, we're going to structure a portfolio around that. What do we use to structure a portfolio? You can be a passive investor. In other words, you want to build up a portfolio of just unit trust funds. There are people that do that. You can also be a bit more semi-passive and build up a basket of what I call exchange-traded products. That's the ETNs and the ETFs, and then blend a whole group of these ETPs together as an investment portfolio. But obviously, we're going to talk about tonight is more shares. So that's where we talk about active investment. I'm talking about the DIY approach, do it yourself. And again, one step further, those of you who are more advanced investors, is just diversifying your portfolio and going offshore. That's still involved with shares. So you want to diversify your portfolio geographically, obviously political risk, all those kind of factors you want to take into consideration, but also taking advantage of offshore opportunities. But ultimately, your goal is also risk management by looking at the quality of shares in your portfolio and also the spreading the risk between the different sectors and obviously different shares. That's how we're going to manage the risk as an investor. But ultimately, how do we make our profits? Through the magic of compounding. The share market goes up and down, and obviously the idea is to reinvest our profits if we sell any shares, as well as our dividends, as well as any additional shares we might get. And I'll use an example a bit later of Apple. Apple just had a share split. Okay. What is investing? As I mentioned just now, it's for the long term. Okay. Your goal as an investor is to try to achieve at least between 10 and 15% annual capital return. My goal is such, I always look at 50% with the 3-year view. So that's looking at about a 50% return every 3 years. And obviously, it's a portfolio of shares. So there's some shares that might do better, some would do worse. It's the average of your portfolio. You want to take advantage of certain benefits along the way. So if you've got some property shares in your portfolio, you might be getting interest. Yes, they pay out in the form of dividends, but ultimately it is interest. You also want to get perks like dividends. And there we're talking about between 3 and 5% dividend yield. And I mentioned just now about the share splits. Apple had at the beginning of this month a 7-for-1 share split. The shares were trading at $790. If you had $100 shares, your portfolio just in Apple was $49,000. That is 7-for-1 split, made it more affordable for the man on the street. Went from $490 to $70. And since then, the share price has gone, this is when I looked at the price today, has gone up to $92 a share. That is a 31.43% increase since the 9th of June. okay, very short period of time. So that's the advantage also of being a long-term investor. You take advantage of your share splits, more people can get involved, creates more demand, pushes the share price up higher. So those are some of the perks also along the way. But saying on the upside, there's also the downside. Okay, there's risks involved. Markets move up and down, they fluctuate. And as an investor, we talk about riding out the downtrends. And hence again, I want to highlight the importance of sticking to good quality stocks. We talk about blue chip shares. Company's been around for a long time, good consistent management, results and things like that. But there will be times where those shares will fall. Okay, so you'll wait out the less profitable positions with the expectation that the market will rebound. Okay, the market will bounce back. So any losses along the way will be recovered. That's your thinking, your mindset as such. But again, as I say, we're talking about the quality of the stocks, but also if you've got a well-diversified portfolio, you've got some financial shares, some industrial shares, and some resource stocks, you'll have a balanced portfolio. That also helps mitigate the losses on the market. Investors are typically more concerned about market fundamentals. Okay, we talk about reading financial statements. Obviously, the three statements I refer to them as balance sheet, income statement, and the cash flow statement. And from that, you'll get a lot of financial ratios. There's more than 20 financial ratios that help you determine, first of all, is this a company that's going to grow? And also, what's also more importantly, what's the health of the company? But as an investor, you also look at things like management forecasts, also to point to growth prospects. This gives you that confidence factor. Yeah.